on my mind since I went to the #1 business school in the land when I went there, University of Chicago Booth. And then I was an investment banker for 6 years. I was advising startups and incubator programs and accelerator programs. I still do that. I'm a Kauffman fellow. I, been investing for years now, right? So I prepared for, like Game of Thrones, winter's coming. I got my coat on.
Only real content is gonna last. All that other nonsense is here today and gone tomorrow.
Welcome, everybody, back to another episode of Navigating Now, a different podcast. I am your humble host, Des Cole, joined as always by my co-host, Jay Bartlett. And today we are super, super honored to have Sherman Williams on our podcast. Sherman has done a lot of things in the world of VC and tech. He has a super long list of accolades. So I'm going to actually pass it over to him. First of all, thank you so much for joining our podcast. But I really just want to give you the opportunity to tell the people just a little bit about where you're from, how you ended up here.
Absolutely. So, how you doing, everyone? And for the different team, thank you for having me on. I'm excited to do this. I'm the managing partner and co-founder of AIN Ventures. And we are a fund that invests at the intersection of dual use and deep tech. Dual use means companies that have both government and commercial applications. Deep tech are companies that are building technologies that are out of the R&D phase, but those technologies do not yet have wide-scale commercial adoption. And those same technologies have the ability to either disrupt an existing market and or create a brand new market. So think, to bring it home to the audience, think about things like artificial intelligence, machine learning are some great examples of that. We specifically at AIN invest in space technology, sustainability technology, and healthcare technology. Those are the key areas we focus on. We have another part of our mandate, our investment mandate at AIN Ventures, where we invest in veteran-led startups, military veterans. I'm a veteran, and so is my co-founder. So that's something that's near and dear to our hearts. And the military is overrepresented by minorities. I'm African American. My co-founder is a woman. Investing in that community, in those communities, in minority communities, we call them underestimated communities, is extremely important to both of us, to Emily and I. And so by investing in veterans, quite naturally, you are going to come into contact with a ton of minorities. And so that's another portion of our investment mandate. So that is me. In my past, yes, I've been working for some time now. Been working on AIN for several years, for a couple of years, but it's been in the thought process for about 3 years. Prior to that, I was an investment banker. Prior to that, I was a military officer. So great to meet you all.
Yeah, for sure. Thank you for the quick intro. I'd like to first just get into, you said the military was a big part of your life and one of the main drivers in the work that you do today. Could you just speak on how you went from, or just like your initial thought pattern of your trajectory from when you were, say, like in high school? What did you feel like you wanted to do, and what paths were you trying to go down?
Man, honestly, when I was in high school, I think overarching, like, big themes, I knew the right thing to do. But when it came to the tactical, I was just living, man. I was a knucklehead a little bit. I was just kind of out there, just living. Didn't really have. I went to the Naval Academy, so I definitely had it in me. But I don't think that I had anyone bring kind of that grit out of me yet at that point. So I was just kind of floating, and honestly, life was a bit easy, and I wasn't trying to take on additional tasks, extra tasks, etc. in life, which is unfortunate because you lose out on a few years. You lose out on several good years, right? I think pretty much all of high school, I could have done a lot more. I did enough, like I said, I did enough to go to the Naval Academy, but I could have done much, 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 much more. But I just didn't really grow up in an environment that really pushed me to do more. And no fault to that environment or those people. They just didn't know, right? Working class community, working class parents, et cetera. So, but I did learn a lot from my parents. My parents moved out through education and educational attainment. When I was growing up, my parents were poor to working class. By the time I was in college, they were moving nicely into the middle class, and they where they are today, right? My mother graduated from. My mother got an advanced degree my junior year of college, right? So that was very similar, to me. So, growing up just didn't really have that. What really kind of put me on the right. So high school was kind of a wash. So what put me on the right track was going to Naval Academy. Because Naval Academy will bring it out of you. It'll bring it all the things.
I was gonna say.
It will bring all the things out of you. And I think that goes for the military. It's a very unique portion of our society where you really have to put up or shut up. And I think a lot of us have it in us to put up, right, and do well and do what needs to be done to win. At whatever we want to win at, but often in life, you can a lot of times you just kind of float by, and the military will not allow you to do that. So, I think it started off my journey. You asked me about high school, I'll flip it and say it really happened for me in college, and it honestly, it probably took about 2 years of college to where the light switch turned on to some degree. It's like, okay, we're going to work hard. We're going to get focused. But it wasn't even where it needed to be even at that point. I would say probably about 24, 25 is where it really, really, really flipped on for me, the switch. And I was like, okay, we're going to seize the day. Every second counts. Every moment counts. And this is a journey. Some people get it at 12. Some people get it at 15. Some people get it at 25. Some people don't get to 50, 45, 50. Right? For me, it flipped on at 25, where I was like, okay, we're going to conquer this thing called life and seize every opportunity.
Yeah, that's dope. That's I'd say it's kind of similar to my experience as well. It took like sophomore year, 2 years in college, where I was like, oh, yeah, we need to start moving. You know what I'm saying?
Yeah.
So yeah, like once that clicked for you, you said you went from the military, and then you said you did something in between the military and VC.
Or wait, could I actually? I want to bring up something real quick, because I remember one of the first times, Sherman, I talked to you. You told me one of the really inspirational moments was when Elon started SpaceX for you, and like you saw people like kind of private citizens going to space, and just like the scale and the economy of all of that like inspired you. Could you talk or speak on that a little bit?
Yeah, man. So it was actually a rolling thing. So what happened was I was in Afghanistan in 2008. While I was in Afghanistan, Elon got the fourth. It took him 4 rockets to get off the ground. To 4 rockets to actually successfully get above the Kardamar line, successfully get into space. And I think it was like September 26th, I think, 2008. And it was like, for a lot in certain circles, it was like, whoa. I think he was the first. I know he was the first private citizen to put an object into space. So it was wildly impressive. So that's when I really started digging into VC. I'm like, what enabled this, right? And then I discovered what PayPal was, and I had heard of PayPal about 2008, but I really was able to dig in and see. And then at the same time, after I left Afghanistan, I moved to Asia. And in Asia, VC was a thing. 07, just a year before that, iPhone came out, right? Mm-hmm. You started seeing, you started hearing the terms venture capital and venture-backed startups, and they were growing rapidly. And these were companies that were kind of on the move, right? And it wasn't, a lot of those companies really didn't get penetration until probably that 2011, 2012 timeframe. but you really started to, I was able to see it, just the whisperings of it, in that kind of 2008, 9, 10 time frame. And I was over in Asia, and I'm from Chicago originally. And, Chicago, one point years ago was the fastest growing city in the world. It was like in the 20s, from 1920, something like that, or 100 years ago. And it was just a rough town. It was all about business and commerce. And, the same thing with New York City, where I live now, I live in New York. And, man, Asia, just to me, I'm a big history buff. And Asia, to me, seemed like what I read about what Chicago and New York were in, like, the 20s, if that makes sense, right?
Right.
Where it was just scaling like no other. Like, you in China, or it's just, I was in South Korea a lot, and you just building things being built overnight, and just, fortunes being made, and it was just fascinating to me. And what luckily, I've never been great. I've been okay from a tactical standpoint, but that's not my zone of genius. I think my zone of genius is being able to look at a situation and understand that from a strategic standpoint, how things were like shaping up, right? And being able to discern and put myself in the right position. So what I quickly started to understand was, looking back, I couldn't have articulated at the time, but now I can. I understood that when it comes to this society that's been built, right, this post-World War II society economically, you want to sit on the equity side of the house. You want to own equity in things. Because when it comes to equity, things are valued at a certain level one day, and they can be valued at another level the next day. And I understood that it wasn't about getting a paycheck and working for someone else. I understood that. And I understood that no matter how big your paycheck was, $2, $5, $10 million a year, it still was different from, you own a company that's valued at $100 million, and then a year later, the company's valued at $1.5 billion. It's just different, right? And so I got that. So then it became like, okay, where can you best play on the equity side of the house? Where there's the public markets and the stock market, right? Public companies.
Mm-hmm.
But then there's the private markets where venture capital is. And there's also private equity, et cetera. And I understood, I wasn't completely sold on venture capital, although I said in my business school, I went to business school. So that's what I did in between for everyone. To answer Dev's question directly, I did business school at University of Chicago, and then I was an investment banker. But I was like, okay, I don't want to be on the sell side. I want to be on the buy side. Like that's where you need to be. Mm-hmm. All right, cool. How do I get there? And then where do I want to be? Well, I went to investment banking. I went to business school and I went to investment banking. While in business school, I interned at a VC shop. I was exposed to private equity while I was an investment banker post B school. But then private equity was great, but a lot of it was financial engineering. And what happened was I was in banking from 2012 to 2019. And what you had then was the greatest economic run in U.S. history, really between 2009, 10, and 2020. It was the greatest economic run in U.S. history. And I was able to see that. And it may never happen again in my lifetime, right? Because that run was a unique mix of factors that promoted growth. And growth at all costs, effectively, right? Mm-hmm. Now, I actually think that run, that run may not be repeated, but it will happen in pockets. And I think it will mainly happen in high technology pockets, because that run enabled the development of technologies that are going to propel humanity forward for the next half a century, even longer, right? And I have a whole thesis behind that, and I'll get into that later as to why. But I saw that private equity was great, but a lot of it was financial engineering. The true wealth creation, job creation, innovation was occurring in venture capital, right? Mm-hmm. And so I knew that I kind of made the decision, okay, that's where I wanted to play. And not to mention, it's hard to go from a post-MBA associate slash VP slash director to private equity. It's hard to make that transition. So I was like, okay, cool. Venture capital it is. Now, venture capital has multiple different asset classes. There's growth within an asset class. There's growth equity, there's regular venture. There's crossover rounds, which is before you go public. There's growth equity, which is kind of the same thing. There's regular venture capital, and then there's early stage venture capital, and then there's even angel investing, right? And so I had to take a look and where was it best to play out. And I knew that where I eventually wanted to be was early stage venture capital. And it's been a blessing that it's worked out that I'm able to be in early stage venture capital, which is where I play. I'm an early seed, pre-seed investor. Right, so I'm just above there's friends and family, then there's angels. Friends and family and angels are kind of mixed. And there's friends and family and angels, but I say angels are a little bit higher. And then from there, there's like pre-seed and early seed. Then there's later stage seed, because seed rounds are much bigger these days. And then now there's Series A, B, C, and then growth equity and crossover. So that's kind of how my thinking came about. And I was just a young man. I'm from the south side of Chicago. Just a young man who was, didn't grow, no family in finance. I mean, I'm from Chicago, man. So, no family in finance. Definitely don't know anything about venture capital or any private equity. I'm the first banker that I know of in my family, investment banker. I was the first one in my family to go to a top MBA program. Not my family has accolades. I have doctors and lawyers in my family, et cetera, right? People who did that, but they, that's a high age. That's a high earn. They went the route of I'm going to get a paycheck, and I'm going to get a good paycheck. And I was one of the, I have entrepreneurial people in my family, but most entrepreneurial people in my family don't have college degrees, right? But I knew I was fortunate enough to be put in positions to soak up knowledge, right? And I had that post 25-year-old mentality, right? And you combine those two things, and you become a monster, where you just like, okay, we're gonna seize the day. It's not about I use the word conquering. The older I get, the more loving. I try to move from a place of love, but it's just about seizing the day and just taking every advantage I can.
Absolutely. And we're going to dive deep into VC private equity and understanding that. The first place that I want to start is a few of the networking groups that you are a part of, I guess. Techstars and KAUFFMAN Fellows. Can you explain your relation and what those are?
Yeah, so Techstars first. So I'm the VC in residence for the program. I basically help the program select the companies that are going to participate, right? So it's something that's near and dear to my heart, something I love to do. I'm also raising the fund for AIN, so I don't get to dedicate. I have to be conscientious about the amount of time that I spend on it, but it's interesting. It's been a bit stressful, trying to do other things outside of AIN. But Techstars is something that, if I'm afforded the opportunity, I serve at the pleasure of the MD I work with, Matt Kozlov. He runs Techstars LA, Techstars Space Tech for everyone listening. As long as I'm able to work there, I'm 100% going to do it, and I'm going to give of myself to that program and be as helpful as possible. 100%. I'm going to do that. Fantastic program. It is a 3-month accelerator program. I like to say it's an accelerator program, not an incubator program. I believe there have been a lot of people who said negative things. People have mixed views on Techstars and Y Combinator or some of the accelerator programs. The numbers speak for themselves with respect to survivorship. So your startup has a much better chance of surviving if you do an accelerator program And I would argue of the accelerated programs, Techstars is definitely one of the best. I would say that there's even variability within Techstars because Techstars runs like 50 plus accelerator programs. And I would argue that, of course, I'm biased, that the Techstars LA program is arguably one of the best because I know that the people who are there, including me, are fully dedicated to seeing those companies be as successful as humanly possible. Period. Full stop. Right? Now you'll hear people say, "Oh, you don't like certain ideas." You'll hear people talk about race. You'll hear people talk about sex. Let's have it out, right? We care. There's every race, color, creed is pretty much exists within the program team between the program manager, the MD of the program, the VCs and residents in the program, the business associates in the program, and we are there to see those companies, be successful. And so it's been a pleasure to work with that program. It's something that I don't even know if the program realizes, but I have my eyes on doing a lot more with the program over time in different ways to be as helpful. I'm just trying to make the program be as successful as possible because it's a beautiful thing that exists. There are a lot of people that have tried to start accelerator programs. A lot of them are not still around. Techstars has got, I think it's the largest in the world. It's an entire consortium of programs. So that's something that I do. I work with the Techstars LA and Space Technology Accelerator programs. And for everyone listening, like I said, 3 months, you actually get a bit of funding. You get exposure through going through the program. We help you rethink how your startup is going to perform and how you should build it. The idea is to give you what would otherwise take you 3 to 4 years on your own, pack that into 3 months. You get invaluable mentors for your company also, because a lot of this is about network and mentorship to see your company be successful. And we set you on the right path. And for numbers wise, about 15 out of all startups that get going after 5 years, you'll see about 15% that are still alive in some way, shape, or form. Techstars flips that on its head. And Techstars, if you look 5 years out of companies that graduate from this cohort, about 85% are still around in some way, shape, or form. Techstars, last time I checked, was averaging about 1 unicorn every 55 companies. And that's over $1 billion. And if you include the companies over 100 million, obviously it's going to be some amount less than 1 to 55. Maybe it's 1 to 25 or 30, whatever the number is. I'm not sure. But it's less than 1 to 55. So it is a fantastic program that, I know the management just changed over and they're really doing their best to really harness the value of it. It's a lot going on. But I would suggest any entrepreneur should be looking at the Techstars consortium of programs if you're thinking about building a business. Now, the KAUFFMAN Fellowship started by Ewing Kauffman. Ewing Kauffman was a serial American entrepreneur back in the 50s and 60s. He believed that entrepreneurship was the thing that differentiated, pun intended, differentiated the United States from every other country in the world. And he wanted to see more entrepreneurs. He wanted to really invest in entrepreneurship in the United States. So he started basically a foundation. I think it started like in the 60s or 70s. They do that for years. And it's actually one of the biggest entrepreneurship promoters in the United States, I think even still today. In the late 90s, they realized, as a matter of fact, it was like 96 or something like that. They realized that you needed people to invest in entrepreneurs, right? They started a fellowship program for venture capitalists. And what that program was to ensure that you had the absolute best venture capitalists to invest in those best of breed entrepreneurs that were going to continue to propel America forward, continue to differentiate America. And so I am in class 26 of that program. I'm super, very, very fortunate and have all the gratitude to be a part of that program. And through that program, I'm around the best, 55 venture capitalists in the world. Only about half of us are from the United States. The rest are from everywhere from Saudi Arabia to Ireland to Australia to New Zealand, right? And Latin America, all throughout Latin America. And so these are every year bringing in about 50 to 60 of the absolute best venture capitalists who are up and coming. People who are not quite established yet, haven't quite made it yet, but they're up and coming. Bring in the best ones in the United States. United States and around the world together to learn. It's a 2-year program. Every 3 months we meet in person. So think about them almost like an executive MBA. In between the cohorts come together on a quarterly basis. We have like homework assignments, et cetera. We have things that enable us to get together. And it has been a blessing of a program because venture capital doesn't really have the barriers to entry. And so you get a lot of people who are not really, you get a lot of people who are not real that are in VC. And KAUFFMAN has been a blessing because you're around real venture capitalists, real people who are, who are going to be the next best breed. It's all about network, right? It's like going to a great undergrad program or a great master's degree program or going to a great high school or elementary school. At the end, it's about what you learn, but it's really about that network that you develop also. And KAUFFMAN provides the best of both worlds. Extremely great learning and extremely great mentorship. And so those are two programs that I'm involved in.
Thanks. I appreciate that explanation. So I've always seen that like on your profile and everything, but I never knew fully like what it was. The next question, like specifically about VC, I want to understand the cash flow of a VC company. Like obviously you're raising money and then you invest it into the companies, but from like where you actually cost beginning and end, what is the cash flow of the VC company?
So let's start philosophically. That's how I like to start. Venture capital was not meant to come into if you didn't have money. The way it's set up today, it's just a fact. The way it's set up, it wasn't really designed for people who didn't have a lot of money. Venture capital, the way it's set up now, was meant for you made some money somewhere else, or through some entrepreneurial endeavor, whatever have you, or you could work for it, work for someone else that paid you, whatever. You made a good amount of money, and you said, I'm going to start to back entrepreneurs with my own money. And then eventually, after I prove myself with my own money, I'll convince others to put in money with me. At a very rudimentary high level, that's how venture capital is designed today, right? And I operate under that parameter. Unfortunately, I came into this game, unlike a lot of other people who are minorities, came into this game without a lot of money, right? And it just kind of is what it is. But venture capital, you need to be thinking about it as if you are basically running an extremely small business. So let's say you have $100 million fund, okay? Typically in venture capital, the people who start the fund have to put up 1% to 2% of that $100 million. So you got to put in $1 million to $2 million of your own money, right? To invest. Because why am I going to give you money to invest? You're not putting up your own money to invest. You only invest in my money. I need to see you put some of your own skin in the game. That's number one, right? And then on top of that, you in the asset class of venture capital, of that $100 million, you basically are taking a loan out of that money to pay to live over time. So that's the 2% management fee model. So basically, with $100 million for 10 years, is typically the lifetime of a fund. 2%, you can spend $2 million a year just for the you can spend $2 million a year just for the operations of the fund, to pay people salaries, etc. But that $2 million is not on top of the $100 million. That $2 million is inclusive of the $100 million. So basically, if you add that up, you actually only end up investing $80 million of the $100 million because you're taking out a loan of $20 million just to live over that 10 years, right? So that's another reality. So that's why I tell you, like Jay, we've talked about this. That's why venture capital in the very beginning requires ruthless prioritization, because you really don't have any money. As a matter of fact, you don't have any money. You're taking a loan out against money that people gave you in order to pay for things, right? Now, the way venture capital works is after you have a fund or two, or maybe three even, you should have one of your investments get really big and return a ton of capital to you. And then you are operating within the parameters of venture capital. And what are those parameters? What I say philosophically in the beginning. The game of venture capital is you already have money, and then you start doing something. So at that point, you have some companies exit, then you actually have money, and then you start operating within the bounds of venture capital a little bit better, right? Mm-hmm. And a lot of people you'll start to see, not a lot of people, but there's some funds like a Benchmark, Steve Jurvetson's fund. Instead of putting up 2% of the fund, they put up 20, 30% of the fund. They're putting up their own money. Right? There are people out there who have $1 billion funds who are putting up 200 million, 300 million of their own money, right? With them and their partners, right? But that's how venture capital works. Venture capital is the way it's set up is actually, when it comes to finance, it's actually quite beautiful. And you can tell it was set up by entrepreneurs versus financiers to some degree. Right? Because, the venture capitalists really don't make money. Me as a venture capitalist, the reality of it is I don't make a ton of money. I really will not make money until my companies exit, are either bought via M&A, mergers and acquisitions transaction, or they IPO, right? Or they become wildly profitable on their own, and they start to kick dividends back to me as a shareholder, right? Which can happen for private companies, right? Those are the only three ways that I will eventually actually make money. So in venture capital, you have to be as a venture capitalist, you have to be very hawkish about the money you get, because I can't operate and say, I got $2 million for the year, but I'm gonna spend $3 million. You don't have $3 million. Your LPs are not gonna. No one's gonna cough up money for you. I gave you what I gave you. Out of that, you need to extract what I gave you and use that for operations. So, and if you look at it, because of the $100 million, that $20 million is not on top of the $100 million. It's instead of $100 million, I'm only investing $80 million. Well, what ends up happening, if you think about it philosophically, I actually have less money to invest. So I have less shots on goal to actually, and the only way I make money is by investing. So you're actually only hurting yourself. So you're incentivized as a VC to spend as little money as humanly possible, right, on operations, and so that you can invest as much as possible, so that you actually have a shot on goal to actually make some money. And that's the actual God's honest truth, harsh reality of venture capital. A lot of people were years, in the market that was running up from 2010 to 2020, those 10 years, a lot of people running around talking about they want to be a venture capitalist, they want to be a venture capitalist. They don't. They're not. They want. I think a lot of them weren't necessarily. I think they were doing it because they thought that it was lucrative, and it is wildly lucrative if you can do well. But I don't think they understand the inner dynamics of venture capital, and there are easier ways to make money. I'm doing this because I'm passionate about it. I want to back human beings that are changing the world, that are moving humanity forward, period, point blank. And I know I can do that through the venture capital asset class, right? That's why I'm doing it. And that helps me, that desire helps me overcome the financial uncertainty that you deal with as starting off as a venture capitalist until you have a few companies exit, and then you can get a nice financial windfall after that, right? So, to answer your question, hopefully I answered your question, Jerry, with respect to some of the dynamics around venture capital.
Oh, you did. I appreciate that. And talking about big money, $100 million, $1 billion, and all these exits, some people, like, everyone views wealth differently. Like, to some people, $500,000 is a lot. To some people, it's nothing. And thinking of like hyperwealth people like Jeff Bezos, they get mad a lot of times because they see them not pay taxes. And it's really like a game with EBIT and IRS and everything. Could you explain from your perspective the game? Because to me, taxes are just a game to incentivize private social well-being, but they don't publish the rules. So your thoughts on that?
So taxes are absolutely necessary. There's a funny saying: two things in life that are guaranteed: death and taxes. Ever since you've seen, societies, ever since you had tribes of humans coming together, they typically all had to cough up something for the greater good of the village, the tribe, the nation, the state, or whatever have you. We've had that since you had human beings coming together, right? And human beings, Homo sapiens, have been coming together for a long, long, long time, right? Otherwise, we couldn't have defeated animals, beat back nature, farmed, etc. So taxes are necessary, 100%. I believe so. Now, what is also necessary is the efficient use of taxes. And there are things that cause taxes to go up dramatically. Wars are probably the best example, right? It was very common back in the day, when groups of people would come together, they would have a leader. That leader would want to go war, either they want to defend themselves or they want to go take other areas, and they would go tax their people, in order to raise enough money, in order to go fight said war, right? So taxes are going to be around as long as humans are coming together in groups. So they will be here forever, from our perspective as humans. And so I don't have a problem with taxes. I do like flat tax versus progressive tax, etc. I do think that I'd have to look at the numbers. I've never actually put out open up Excel and ran the numbers myself. I do like the concept of a progressive tax system, though, versus just a flat tax. I do think there's an issue with respect to tax loopholes, right? Which I think is what you're intimating at with respect to wealthy individuals not paying enough in taxes, not paying taxes. So it's a misnomer that wealthy individuals don't pay anything in taxes. They do, 100%. But the problem is, are they paying their fair share of taxes, right? Because things are taxed differently in our system. There's a tax on labor and there's a tax on capital, right? And tax on investment, right? So the tax on labor can otherwise be described as income tax, right? And that depends on your tax bracket, right? And then, of course, your local municipality can have its own tax assessment. Like New York City famously has a city tax, or for each individual in the city, in addition to your income tax rate, and you have the state tax, in addition to the federal income tax rate, right? And that just kind of is what it is, man. For that, you just kind of have to eat it, and it is what it is. Now there's a tax on capital and tax on investment, and when you talk about a tax on, well, really that's reflecting the long-term capital gains tax rate, right? Which is inevitably, it has to be lower than the income tax rate, because you want to incentivize investment. So you incentivize, instead of people actually just trying to get money out of a project right away and collect a salary, you incentivize people putting money into a project, and that project being around for quite some time, right? And so I see that as being a good thing. I actually wish that the long-term capital gain tax rate were higher, and I believe that corporate taxes should be higher. Me personally, you asked me my beliefs, I give you my thought. I believe that corporate taxes should be higher. I believe we can actually probably raise the rate on income taxes a slight degree, but I believe that we should incentivize investment, because the benefit to society for investment is pretty dramatic. It's really large. Now, I know our tax code, for instance, heavily favors real estate, old school industries, real estate and farming, and things like that, which are necessary. You need food and you need shelter, right? They are necessary to some degree, but I believe that technology should also start to gain in those benefits with respect to the tax code. And right now, technology does not largely benefit. There's something called Qualified Small Business Stock Tax Treatment. I encourage everyone listening to Google it, QSBS. Again, Qualified Small Business Stock Tax Treatment. That incentivizes early stage investing if a company's equity value is less than $50 million, right? But I think even at $200, $300, $400, $500 million, you want to encourage investment into technology, and that's not really encouraged today. So that's kind of my belief on the tax code. I don't believe the government gets it completely right. I'm actually opposite. I used to call myself fiscally conservative, and I'm everyone says social liberal, fiscally conservative. I am not as fiscally conservative now as I used to be. After going through COVID and seeing basic universal basic income, basically checks being handed out, PPP being handed out by the government to individuals, right? That was mind-blowing to me, seeing that on many different levels. I think we'll all reflect back 10, 15 years from now and be like, wow, what just happened? But I think the government has a very big role to play. I actually think it does in society. And I do not believe in small government at all costs. I'm very pro-military, and I fundamentally believe that you either you're not being thoughtful if you say you're pro-military for small government. If you're pro-big military, small government, you're not being a thoughtful individual. I would love to, in that situation, I would love to open up Excel with you and explaining to people how government works, right? Now, can the government spend money, our tax money, more efficiently? Which, if they do, could result in us paying and them lowering taxes so they don't need as much? 100%. And should we, as the citizenry, hold them accountable? 100%, right? We should do that. But me having lived overseas a ton, I lived in a lot of different countries. In addition, I've lived outside the United States for 5 years of my life. In addition to that, I've traveled outside the United States a good amount. I do believe our country, for its size, does operate actually at a fairly efficient level, but it's not good enough. We should consistently hold their feet to the fire and hold them accountable. That's the reality of things. Now, that's what I think about tax and tax code. Now let's go to wealthy individuals not paying taxes. I did kind of address that a little bit. It's actually not true. I do believe they could probably pay a bit more, for sure. I believe in there was an old school concept of trickle down economics, effectively, of the less these wealthy individuals pay, they will spend more money in their communities, and they know better to do with their money than others. That's BS. That's been disproven over time. When I was, in the 80s, I was a child, but I really don't remember anything. But, looking back and reading about it, that the wave of Reagan when he came in, in 1980, was that, he's going to cut taxes, and it was going to, it did promote economic development. It spurred economic growth, like a dramatic amount of growth. I mean, the United States, post 1980 and really post World War II, has been a miracle. It's been amazing what has happened. But the U.S. form of the way we've done it has created dramatic inequality, right? And you've seen a whole cohort of people, including a lot of people that look like us on this podcast. Let's just address it, right? African Americans, Latinos, et cetera, who have not been able to benefit from that growth, and that's not just that's not necessarily due to the tax code. That's just due to systematic racism. We'll just call it what it is, right? There are other things that are involved in that situation. But I do believe that these wealthy individuals, the ultra high net worth individuals, they should pay more in taxes. I think low tax at all costs is not going to necessarily trickle down. It has not trickled down. It just hasn't, right? So that was the thesis before, and it was wrong. We now have about 40 some odd years of data. And where are you going to move to? China? You move to Europe now? A war in Europe? Right? I was telling people, you know, it used to be, you know, we were scared to raise taxes. These people are going to leave. Where are they going to go now? They're not going to go anywhere. You know, we have the rule of law in this country. Despite all our issues, it's the best country in the world to live. I firmly believe that. You know, I was in the military for almost half my life. By the time I got out, I fought for it. Multiple deployments. And, you know, I do think that there needs to be a higher proportion paid by not only the wealthiest individuals, but also corporations, right? And I don't believe those corporations have a viable alternative country to move to.
Gotcha. Word. Interesting perspective, especially from, you know what I mean, someone who I would consider wealthy yourself. But moving on from taxes.
I'm not wealthy, brother. I'm on borrow. I'm very much on borrowed time. With as I told you, I explained to you the VC model, right? I'm in borrowing mode. I'm waiting for my big exits.
Okay. So going into that, you want to wait for the big exits, but how do you get started in private equity? You started AIN, but I know that you did the whole private portfolio first. How do you make those first few investments, find the first companies?
Yep, absolutely. So the way, and it's not private equity, it's venture capital, right? So the question should be, how do I get started in venture capital? But the way I get started was I basically took money that I was otherwise spent elsewhere. I did very well saving my money as an investment banker, right? I saved. I paid down all my debt. So I was debt free completely. And then on top of that, I saved. So I would take my entire investment banking bonus and I put it away. To the point where my financial advisor was like, man, you don't want to get a watch or just do something nice for yourself? And I was like, no, I'm good. You know? Because the best thing to me in life is options. Right? And I didn't want to limit my optionality at all whatsoever. So I saved extremely well and have benefited. And that's how I got going, because I took that money that I saved, I invested that money in myself and also into companies. And myself as far as gaining knowledge, and then investing into companies. And have built up a track record that I can put out to the world, right? And also, the money that I saved has enabled me to go with very little income and start AIN, because I'm not taking a salary out of AIN, right? Mm-hmm. So that is what, not yet, right? You know, I hope to very, very soon. But that is what has enabled me to get going.
Got you. But like, I want to ask, like, from deal flow, like, where do you find companies that present decks and they're like, oh, this is my idea?
Oh, 100%.
You know what I mean? Like, where do you find the first?
Yeah. So networking, putting yourself out there, making yourself vulnerable, going to Techstars, going to demo days. I think I went to my first Techstars demo day in 2014 or 2015 or something like that, 2014 even. Going to different incubator programs, and I started going to incubator programs, not non-Techstars, incubator programs in 2012, 2011, and saying, hey, I just want to just go to your demo day, meet companies, be helpful. Is there any way I can help? Right? And just getting involved, looking at business models, looking at things, getting involved that way, just throwing myself into it. That's how you get going. And eventually you get reps, you get a great eye, right? You have a true eye for talent. You start to develop an eye for talent, right? Because at the end of the day, a startup is all about the people in the beginning. That's all there is in the beginning, right? It's just, you know, the quality of that team. Even if you have some high technology, like we invest in very deep, we call it deep tech. Other people call it frontier tech. But even that, you still got to sell it, right? So, you know, and that takes a certain type of person, and that person needs to be able to build a certain kind of team. So, you know, we, I'm basically threw myself into entrepreneurial pursuits, venture capital, while working as an investment banker, right? On the side, I was constantly putting myself out there in order to get to where I wanted to be, right? And other thing too is in banking, I use banking as a tool to learn. That's what I was there for. Now, while I was there, I definitely wanted to do well, 100%. But I use it as a tool to learn. That was my thought process.
Okay.
So
Actually, if you don't mind, I want to kind of, it's bringing back, but I guess it's kind of also talking about just like the deal flow and like how VC works, just like conceptually. I remember you talked about just like the different types of almost strategies for VCs. There's like angel investing, there's early stage investment, and there's, I know you named a couple of others, but could you just explain the difference between some of them and why you do
100%.
early stage investments?
100%. So let me bottom line up front. Per the numbers, early stage venture capital investing is the number one returning asset class in the United States in about the last 45 to 50 years. Cambridge Associates comes out with a report on that. I don't think I've looked at the report in the last probably this year, but and as of 2021, that was true. And that just is what it is. Early stage venture capital means like kind of seed, and even I think they're including like Series A's in that field, right? So you know that is that. Now, what are the different classes? I'll lay them out for everyone. Let me back up. That's why I participate in early stage venture capital, because it's the number one returning asset class. If you're going to do it, you might as well go all the way. Now, there's some unique things to be said here. Anytime you make an investment, you need to probability weight it, the expected value return, or you need, another way to say, you need to look at the risk that you're taking, okay, with that investment. All right. Early stage, now 98% of the returns in early stage venture capital are in 2% of the companies. The majority of the returns are in 2% of the companies. That's the reality of things. So when you probability weight it, there are other asset classes that probably make even more sense to participate in, unless you have a unique network/asymmetric advantage that will enable you to do extremely well in the early stage venture capital asset class. If you don't have that advantage, you might want to go in private equity. The returns are not necessarily as good in private equity, but you don't have 98% of returns and only 2% of the companies. They're more evenly spread. There's also real estate, right? You don't have as good returns as private equity and or venture capital, but it's easier to make money. So it's easier to make 2-3 times your money. You'll never make 100 times, 1,000 times your money. It'll never happen. But you can very easily make 3 to 5 times your money. Well, not easily, but you can make 3 to 5 times your money, right? In real estate, and then there's public stock investing. We call it public market equivalents, right? S&P 500, Dow Jones, Industrial Average, Russell 3000 Index, 2000 Index, 1000 Index, right? So investing in the public markets, right? And exchange traded funds, et cetera. So I just want to kind of give you that. Private equity is a very difficult game to play. It's not something to take lightly. I kind of hinted before. I'm concerned about all the people in 2010 to 2020 that said they want to be VCs. I don't think they were methodical and thought about it. They weren't thoughtful. Some people say they were, and now it's going to be harder to make money with interest rates going up. A lot of people are going to wash out of being VCs. They just are, 100%, right? Our lives are on the line of AIN. You know, I mean, to me included, right? So it's not. I'm just not saying they. No, but I'm confident that I've been thoughtful and I prepared for this, right? I've had this on my mind since I went to the #1 business school in the land when I went there, University of Chicago Booth. And then I was an investment banker for 6 years. I was advising startups and incubator programs and accelerator programs. I still do that. I'm a Kaufman fellow. I, been investing for years now, right? So I prepared for, like Game of Thrones, winter's coming. I got my coat on. You know what I'm saying? So, whereas everyone else, they got on flip-flops, they got on slides and Nike shorts,
right.
and a white beater, and it's going to get cold, and I don't know, we're not on the beach anymore. So, that's that. Now, I just want to kind of give that hint, that not hint, but I want to give that, disclaimer on VC, or early stage venture capital. Now, when it comes to the different asset classes within VC, or the different levels of VC, there's angel investing, right? Friends and family. You'll probably, let me get some dollars. You'll probably, it depends on how wealthy your friends and family are, right? But you're probably looking at less than $250,000 or less capital raise. So you're literally going to your brother, sister, uncle, aunt, second cousins removed, parents, wife's family, your girl's family, your people you went to college with, anyone you can to raise some capital at that friends and family round. So that's your initial round. I got an idea. I love some money, so I can start building. Cool. The next round is the angel round, and there are serial angel investors. And these people put in real money. People put in anywhere from $5,000 checks to $200,000 checks, right? As angels into company, and there are angel groups that have come together and give someone $1 million, right? And so a lot of angel groups are affiliated with different universities and et cetera. And little private investment clubs. The private investment clubs have also kind of effectively been around since humans have been around and civilizing, right? To some way, degree, way, shape, or form. After angel investing, and that's what I was initially. That's how I started and built my track record. I was an angel investor. I actually have never truly been a friends and family investor. I've looked at potential investing at that level, but I've actually never pulled the trigger wisely. We actually call it friends, families, and fools. That's what that round is. So the angel investing, there's friends and family and fools, there's angel investing, and the next thing, can you hear me?
Yeah.
Yep.
All right. The next thing is pre-seed investing. So pre-seed investing, you'll probably see a check of $500,000 to $750,000. It could be as low as $250K. The company will typically be less than $10 million in value. It could even be low as $4 or $5 million in value, right? Company has no traction at all, right? And so that's the key to pre-seed investing. To understand if you got a pre-seed company is the company has no traction. That's the pre-seed investment. Okay. Then there's seed stage investing. Seed stage, you'll see typically companies raise between $1 million and $4 million, right? You'll see companies raise between $1 million and $4 million. They are typically going to be valued at, $25 million or less, right? We actually we are early seed investors, so we try to get at $15 million or less for AIN Ventures. This is where you get real institutional capital, hardcore looking at how your company's performing. And at this point, you either have initial traction for your company, or you have a company that is going to take a while to actually commercialize. The technology take a while to commercialize. But what you're doing is you are, what you're doing is you are developing the product, and you have evidence that the product is developing and is on the path to eventually be commercialized. So either that is occurring or you already commercialized and you are finding traction in your company. There's a concept called product market fit, right? Mm-hmm. And if product market fit should be assessed by looking at financial metrics of how the velocity of that product being purchased and how that product is being utilized by the customer. Okay? And this is at the seed stage. Typically, you have traction, but you're in the pre-product market fit phase. So the pre-seed phase is to give you money just to go build the product. The seed stage is to give you money to go find product market fit. Go explore different customer segments, examine how your product is being utilized by those customers, how they're buying it, et cetera. And then we can try to find to say, hey, I have a point where I know I have a product and it's measurable, observable, and repeatable as with respect to how to sell this product. Okay. The next stage is Series A. Classically, Series A, you're looking at probably raising between $10 and $20 million, right? And for these rounds, you say, what is the value of the company? Typically, in each round, you sell about 20% of the company. That's about what you do, right? At the Series A stage, you should have product market fit. You should have the financial metrics that helps you understand that this company has product market fit. You should be looking at lifetime value of the company relative to customer acquisition costs, like LTV to CAC. You want it over a certain amount, repeat customer rate. I have a whole Bible of key performance indicators that I utilize, and I quickly look, and it is literally the same thing as looking at an athlete in the NFL draft or in the NBA combine, right? An NFL combine, that's 40 time bench press, lateral movement drill, vertical jump. What's the other metrics? Broad jump, right? Mm-hmm. You just have these KPIs, and it depends on the business model of the company and the kind of company it is. But for each different kind of company, you have these KPIs. And look, either you ran a 4.2 or you ran a 4.5. I don't know what to tell you. You know what I'm saying? You run a 4.2, you're a first round draft pick. You run a 4.5, you might go fifth round. It just is what it is, right? And so at the Series A, no, for real. At the Series A, it's just straight up. It should be at that point. Hopefully, you have metrics to go off of. The company should have product market fit, and what you're doing is you're giving the money company to expand their sales force, right? So that they can go because their sales processes at that point should be measurable, observable, repeatable. You're giving them money so they can just expand sales. Right. So that's what's happening at that stage, right? Now we invest in companies that are deep tech. So those companies may not have, even at the Series A, may not have a product that can be commercialized. It's still developing a product. But we at least have a sign that company is close to commercialization, right? And honestly, even for a deep tech company, you should be pretty close to commercialization at around the A. Oftentimes, it may not actually get commercialized until around the Series B or Series C level. But you should, at the A, you should know you're within striking distance, right? Mm-hmm. Now, the Series B is really interesting. We call it the treacherous B, right? At that point, you could be raising anywhere from 30 to 50 to 60 some $1 million for the company. Again, you want to sell 20% of the company so you can back into the math there. Just take whatever number I gave you times 5, right, to get, to the value of the company. Mm-hmm. And at that point, at that Series B level, you should start to care a little bit more about unit level economics, right? So, because and you start to care about that because is this company within striking distance? Does it have a path to get to profitability, right? That's what you care about. That's what you still start to care about at that level, right? For the deep tech companies that we have, the very science forward companies that we have, they very well may not even be commercialized yet. But at a Series B, that technology should be very close to going to market. If not, and honestly, If it's not in market by the B as a deep tech company, it's something to be worried about. Unless it's something really bleeding edge, right? Like fusion technology or something like that. Hey, you just may not quite be there yet. But so that's that. Now, if you do the math, you say, let's say 50 for the B, 20 for the A, that's 70. Let's say at the seed you raise 5, that's 75, right? And the pre-seed, between the pre-seed and angel, you raise another $1 million. So you got just shy of $100 million into this company already to get it going, right? Which is why in venture capital, you're looking for unicorn exits to actually justify the risk that you're taking to invest in that company. Remember, every investment decision should be risk weighted, right? The number one and most important thing to consider when making an investment decision, other than the human being, the number one most important decision to be made when it comes to an investment is what asset class you want to invest in, right? Right? And then what kind of risk are you willing to take within said asset class, right? That is extremely important. All right. Okay, so that's the Series B. Series C, you're going to see a company could raise $100 million at that point, right? At this point, you're starting to identify what kind of exit is this company going to have. And the VC should be thinking about that earlier, but at that point, it should be a little bit more clear. Is this company on a path to go public via an initial public offering? Or is this company on a path to be simply acquired, right? And then how the company is set up is different depending on that path, right? And then and at that Series C level, you're at about that growth equity stuff. And anything at that level or beyond is called growth equity. That's a different kind of investor. You see a lot of private equity firms actually participate at this level. And you could have a situation where the company is actually profitable at that kind of growth equity level. You totally could have that ability, right? And then crossover rounds are companies that invest in companies that are about to go public. Their next round is going to go public. So you're prepping that company to be owned by retail shareholders and large institutions, like the ones that run their control 401ks, pensions, or us when we go on TD Ameritrade and go buy stock, right? And something we're interested in, right? So, that was a little long-winded, but that's pretty much how those are the different kind of elements of venture capital, how things are laid out. And it's a very interesting game. And I encourage everyone to dig into this game, dig into this field, because like I said, this is where the wealth creation, job creation, innovation is occurring in the Western world. Well, in the modern global economy, not even in the Western world, in the modern global economy, the Chinese are doing it themselves also.
Thanks. No, that was a great explanation of VC, all the different stages.
The people needed that.
Yeah, everybody needed that one. My next place I want to go is, how do you look for founders? And has anyone surprised you? Obviously, people being the most important early stage.
I don't want to say something. People are the most important at every stage. I just think that the probability weighting, remember, it's about risk and probability weighting. The probability weighting that you put on the within your decision matrix of an investment, the weighting that you put on the people should be higher the earlier the company is. So people matter in every single stage of the investment. Okay. And that's period, point blank. As a matter of fact, when I start investing in the public markets again, I've paused because I need to save money for AIN. When I start investing in the public markets again, I am actually excited to do so, because to the degree of the information I'm afforded, right, I plan on pursuing my own little private portfolio, Sherman Williams, my own little private public portfolio of investing in public companies that have the absolute best founders, right? Or CEOs, because a lot of times the founding member is not the CEO of the company still, but have the best CEOs. But I have to develop a whole decision matrix on how to assess that person is the best CEO without being able to meet with the person, because I'm afforded the opportunity of venture capital to meet with the person. So that's that. But I think your question was, how do I go about finding these founders? Again, it's through putting myself out there. I'm a mentor for a ton of accelerator programs. I speak, I offer up to speak. I hope a lot of entrepreneurs hear this podcast, right? If you're a company in space, sustainability, or health tech, or something involving defense tech or cybersecurity, or you're a military veteran entrepreneur, come find me. So I'm constantly putting myself out there, right? And I'm going to things, right? I'm consistently going to things, getting off of this computer, going out to try to meet entrepreneurs, right?
Right.
I'm doing that in order to meet these people, and eventually you develop a network with other VCs also. I network with in pockets where a lot of entrepreneurs are coming out of, right? And I do all of those things in order to surface, so the entrepreneurs surface for me. Actually not surface, I go find them, I dig for them. They don't actually surface. I dig for them, get them out from under the ground, right? And dust it off and really take a look at what's up with these companies and what's going on here. And then make an investment decision from there. So it's about developing that network on a consistent basis in order to succeed.
And have I was gonna say, have any of them surprised you? Any of the founders that you've invested in, good or bad?
Founders have surprised me in both a good and bad way. When it comes to founders, I believe that most of my founders' hearts have been in the right place. I've been fortunate enough that every founder I've invested in, their heart has been in the right place. The biggest issue with founders that have not done well and who I've not reinvested into is they didn't tell the truth. And the reason why they didn't tell the truth is because they were in a certain environment and they were trying to make things seem better than they actually were. Mm-hmm. So in their mind, they were doing the right thing and they were faking it till they made it. But once you lose my trust from an integrity standpoint, I'm completely out. Right. Almost across the board, if I didn't reinvest in a founder, it was because I lost faith in that. I lost faith in that person in integrity. Because at the end of the day, it's about making really hard decisions, right? And when I played football, I played football in high school and a little bit in college also. My high school football coach said every game is decided by 6 big plays. That's it. Everything in life, I think, life is like 6 big plays. Every company is 6 big plays. It's not about what you did on 1st and 10 in the first quarter. It's really about what you did on 4th and 2 in the fourth quarter with 5 minutes left and you're down. Mm-hmm. That's what it's all about, right? It's about that inbound pass in the fourth quarter and you down by 3, right? And are you able to get the ball inbound? Did you execute the play, right? Mm-hmm. That's what it's all about. And if I lose the ability to believe that they're going to make the right decision in those 6 big plays, because they'll be okay otherwise. So which means they'll still do okay as a company, but they're not going to perform well when it comes to that big play. Then I'm out. I'm completely out on that company. And that founder, and I'll probably never invest in that founder again. And here's something I've been thinking about a lot, because I personally deal with financial uncertainty, me personally, in my own personal life, starting a fund. I told you, the fund economics are not sweet in the very beginning. It's really not sweet. It's really never truly sweet, but it doesn't really start making sense until about fund 3, fund 4-ish, right? The fund economics, right? Mm-hmm. And so one thing I thought about was, if the best thing in the world is to actually have the skill set, to know you have the skill set. So I drew an analogy for somebody. I said, hey man, you are, I can't remember the receiver on the Saints. A couple of years ago, he had the most catches in the NFL or whatever. Michael Thomas. Not fast at all. I think he ran like a 4.5, Michael Thomas, but he ran like a 4.5, 4.6. But he knows he can catch. Because at the end of the day, this is not a track competition. This is a wide receiver competition, right? Or route running competition, right? And so, you know, and I'm gonna be a little convoluted here, but let me try to get this point out. So I'm gonna try help me stay on track here. I know what I'm capable of, right? Have I ever been the best, the absolute freaking best? No, right? So when it comes to VC and raising a fund, you gotta look at yourself, man. On paper, you're not that dude, but that's okay. Michael Jordan didn't make the high school team freshman year. Tom Brady got drafted 7th round. Steph Curry went to Davidson.
Thanks.
You know, you're not that dude. You're just not that guy. You got to sit back and acknowledge that. But you're going to work harder. You know, over time, you're going to be able to compete, and you're not able to compete. You're going to excel. You're going to beat these other people. But it's whether or not you have the time to actually get there. Now a lot of people run out of time, right?
Mm-hmm.
Well, so what I was thinking of was with founders and with VCs, early emerging managers like myself. What happens is you let that financial uncertainty get to you, and you start making bad decisions, right?
Mm-hmm.
When in actuality, all you had to do, no matter how hard it got, was maintain your composure, stay level-headed, right? And a lot of people starting a small business, people starting a venture-backed startup, emerging managers and venture capital. I think a lot of us, right? And I see it because right now I have big decisions to make, right? But I want to make those decisions from an abundance mentality versus a scarcity mentality, right? I think a lot of African Americans, my people from my community, right? A lot of Latinos, right? Because you grew up in a scarcity environment, right? Mm-hmm. You make these decisions not from an abundance mentality, but from a scarcity mentality, right? And with that being said, what you got to do is you got to maintain your head and you got to make the right decision. Now that will require ruthless prioritization, like I talk to Jay about all the time, 100%, right? But if you're able to maintain your head and survive, right, and it may even thrive a bit through these things, and not just survive, but thrive a bit through this, I think you can be in an absolute beautiful place, right, over time, right? Mm-hmm. And so, with respect to these founders, I think that they allowed the uncertainty to get to them at some point, and they started doing the wrong thing, right?
Right.
And that's what happened. Instead of swallowing and doing the right thing, they did the wrong thing, and they made the wrong decision. Companies suffer for it, and I'm out.
Right. If I may, I'd like to flip the other side of that question, which is, what are the KPIs? Talk about the sports metaphor, like scouting. What do you look for in founders before you just looking at going to the a scouting event and be like, oh, he's jumping fast, oh, he's running fast? What are those KPIs you look for in people before you invest?
So I actually don't look at founders. I don't look at product market fit for some time. Product market fit is a bit of a misnomer because I feel like a lot of people don't have enough data to assess product market fit. What I look at is founder market fit.
Okay.
Are you the human being to sell this product within this market? Mm. Are you that person?
I like that.
Right?
I like that.
That's so I look at that. So that's what I look for, because you could be Michael Jordan on the Bulls, or you could be Michael Jordan playing on the White Sox in AAA.
Right.
That's Michael Jordan did not have baseball final founder market fit. He had outstanding basketball founder market fit, though. The best, actually. Right? LeBron James was all-state football in high school. Right? Founder market fit. Basketball or football for LeBron James? I'm going to go ahead and say basketball. Right? In life and everything. Because he would have been the best tight end ever. Okay?
Right.
Look at that relative to the best basketball player ever, right?
Right.
So I look for founder market fit. And so I'm looking at educational background. I'm looking at work history. I'm looking at, are you approaching the market with some sort of asymmetric advantage? Is your goal, do you have a strategy to go to market that's better than others, that will lower the cost of capital that it takes for this company to be successful? That is what I am personally looking at the when I initially meet a founder, right, and for an early stage company, right? I've got a company I'm looking at right now. The guy has a PhD from one of the top 5 universities in the United States or in the world. And he has a PhD and wrote his dissertation in the product that he's building. That's founder market fit.
Right.
Right. Now, even with that, can he sell it? Right. So who are you hiring? Are you able to attract talent around you to be able to hire that thing? Mm-hmm. Right. But that is the most important thing for me, is that founder market fit. And therefore, you end up having a little bit of a bias towards second-time founders who have successfully raised venture capital funding in the past, founders who have had successful exits in the past. You inevitably have a bias towards those people. Right. Now, with that being said, I want to invest in underestimated minorities, and we haven't been afforded the opportunity to be a second-time founder, or been afforded the opportunity to have a successful exit or raise venture capital funding in the past, because we didn't have the right networks, et cetera. So I'm wildly conscientious of that fact, right? But they still have to have something in their background, right? And then ultimately, when I really get to know them, that's all I'm saying is just for me to have a second or third conversation with you. Right. But what I'm really going to dig in is I'm looking at what you went through in life. Have you gone through something, right? Have you exercised grit and determination? Have you gone through something to get to where you're at? That lets me know that when times get tough, you're going to do what did we talk about before? You're going to do the right thing on the six big plays of the game. Right. Right. That's what I'm looking for. That's ultimately what I'm looking for to back this founder. You went through some shit, right? And you came out on the other side. Because in life, the cool thing about America, the interesting thing about society in general, is we prop up the person that just wanted everything. You know, Ivy League, Rhodes Scholar, played in the league, all this. But the cool thing about America is we love a comeback story. Mm-hmm. America loved Batman. You know what I'm saying? Parents got killed, all this, but you came up, taught yourself technology, right? And you also were rich, right? But then, right. and found a way to get retribution on the people that, that killed your parents or whatever, right? It's that comeback story is big in New York. You got knocked down and you come back, right? Mm-hmm. I do think it needs to manifest itself in a different way in our society, I feel like. But I think we need to better emphasize and have a little bit more admiration for people who have gone through things and were able to come out of those things successfully. And those people that didn't start on third base, right? Right. Those people that started in the batter's box, right? Right. Those people that came from just didn't have a lot of opportunity, but were still able to find their way to a certain level, right? Like I admire those kinds of people, right? The immigrants of the world. I mean, 50% at one point. I don't know if it's still true, but it was like 2018, 2019, 50% of all unicorn startups in Silicon Valley were founded by immigrants. There's a reason for that, right? That they didn't take the easy way out, right? There was a decision to be made, and they made the right decision, and they bet on themselves, largely because they didn't really have anyone else to bet on them, right? Same thing with AIN. AIN Ventures, we started because we didn't have. And we did have someone bet on us. We had a larger fund, a bigger fund that put money into us, right? So we did have that. But I mean, would I have started this if I could have got a job at Sequoia or Andreessen Horowitz? Or probably not. Let's be honest. Let's just keep it all the way 100.
Right.
You know, would you have started different if the #1 marketing and branding agency in the world said, "Hey, we'll shoot you $50 million, come work with us"? No, you would not have. You would not have started different. You would be working with them under their branding, getting paid, right? I love Jay-Z. I love the story of Rockefeller. Rockefeller said, "We tried to get the record deal, right? We legitimately tried. They didn't back us, so we put our own money up." DJ Clark Kent talks about he was walking around the subway with $50,000 that Dame Dash gave him for for some tracks on Reasonable Doubt, right? Like, I tried. I would have taken the advancement from the studio, from the record company, if they would have gave me, right? But I didn't have that, so I had to put my own money up. I put cash up, and they got the cash from somewhere, right? Whatever, but like, that's just facts. So a lot of things start because you don't have other people who necessarily believe in you. You have to just kind of like, you're looking for people. I'm looking for founders, to answer your question and wrap this up, Jay, is that are gonna. They were like, you know what? I'm gonna go do this myself. This is what I'm doing. And they're taking, not just voicing it, but they're taking steps and consistently demonstrating traction to some way, shape, or form, to some degree, that demonstrates that they will be successful over time.
Right.
Thanks. I'm gonna wrap it up with the last couple questions, and I think I was gonna ask, how do I raise $1 million? But from everything that we've talked about in the entire conversation, the answer to everyone would simply be networking, be in the right place at the right time.
100%.
But I want to ask this question, like, really for you, is a fun question, because we talked about earlier, like you said, you're not rich, and we're not going to disclose like any like numbers and net worth, but what is your number that makes you feel like you're rich? And I mean, we've been talking about the structure of VC and what is kind of like being cash poor because the company hasn't exited or whatever yet. What is the number for you, though, that makes you feel rich?
Number one, I don't like the word rich. I like wealthy, right?
Okay.
That's number one. So we'll just start there philosophically. I will feel wealthy. My number is actually, I don't really have an actual number. It's about what I can do, and it's just optionality. I can do what I want to do when I want to do it, with who I want to do it with. So if I want to fly to K-Town for a Black Coffee concert, I can do that, right? If I want to go to London and see Kendrick and Jay-Z perform, I can do that, right? For the weekend. I can take my parents on trips for their birthdays, my nephew, my little brother, my little sister, I can do for them. If I'm dating someone at the time, I can do something for her, right? If I ever have kids, I can do something for them. I can do what I want to do for them. Put them in the best schools, afford them the best opportunities and learning lessons. That's wealthy to me. So I don't know how much money that is, right? But that's what I would want to be able to do. But I don't. A lot of people say they have a number where they want to retire. I am effectively retired. I'm not working. I am working for someone else because I already have LPs in my fund. But I'm not saying I'm retired in the sense that I'm not working for anyone else. I'm working for myself. I'm doing what I want to do. I am choosing intentionally to invest in companies that I believe in and founders that I believe in, more importantly, that are going to change the world. Period, full stop. I want to do this for the rest of my life. At a minimum, in some way, shape, or form, right now, I don't want to say maximum because I don't know what the maximum is. It's to be seen, and I have more lessons to learn in life. But for what I understand now, I would be running a massive alternative investment shop, venture capital fund, multi-billion dollars. I invested from the early stage all the way through growth equity. I also have a debt arm. I will do that I will do that until the day that I die, right? And I can look back, my legacy is that I backed all of these humans. I gave these, at my funeral, hopefully I get over 100 years. At that funeral, I have a 25-year-old entrepreneur that said 2 years ago, this dude backed me, and my company is in unicorn status, right? And it'd be people and he's 80-some years, almost 80 years my junior, right? And he'll have people who are at that point 60, 70, 80 years old who are like, he backed me too, and so, because I believe that with the current economic system, while we have a lot of flaws in this current economic system, and the community I come from hasn't really benefited from it at scale, I do believe there's some tremendous benefits of this economic system that we exist within. And venture capital is one of the most unique and beautiful areas of this kind of global economic system we operate within. And I truly believe, I'm going to be evangelical about this, that these companies can drive the biggest impact. And I want to be a part of these companies, with these companies. Yeah, that's my answer.
Thanks. Last thing I'm gonna ask, and then we'll talk about where people can find you, is what does different mean to you?
Different is being authentic. So I had this revelation several years ago. I mean, I'm an 80s baby. So, the 80s, you just had to be different. You couldn't look like anybody else. I was too young. I was very young in the 80s, but I'm still an 80s baby. It's facts. I was a baby in the 80s. And seeing my older cousins and stuff, you just had to be different. But different is not just being different for different sake. Different is being authentic to yourself. And the coolest thing about life is no one can be you. They can imitate you, the biggest form of flattery, right? Mm-hmm. But they can't be you. So something I think about this, different for me is being authentic, to answer your question directly, to yourself. Mm-hmm. The biggest thing I try to do, and the only way you can stand out and win, I feel like you have to be different, right? Particularly, I feel like for minorities, the game wasn't set up for us to win. It just wasn't. This is not our system. So you have to do something different than other people have done in the past. You just have to, right? So I listen to a ton of VCs and entrepreneurs. Cool. Elon, I listen to him. Cool. I can't do what he does, right? I can be black and to be the best rocket scientist, the best entrepreneur in the world. I still have to do something different than he does. Right. It's the reality of things. It's the game I'm playing, right? Mm-hmm. It's like being an NBA point guard. You under 6 feet. You got to hoop different, right? You're not dunking over the 5, over the center. It's not happening. You got to pull up. You got to get your fadeaway game on point, right? You got to develop some other skill sets. So I thought about, I'm trying to be my most authentic self in all walks of life. Now, there are things that you do that can be off-putting to others. There's nothing you can do about that. You can't help it. It is what it is. But in other instances, try to become a better person. So I'm trying to be the best version and most authentic, best version of myself. Right? And that to me is different. That will enable me to stand out, and that will enable me to achieve what I want to achieve in life.
That's my favorite one so far, bro. I'm just gonna say it right now. We ask everybody this question at the end of our podcast, and I love that response because I wholeheartedly agree. Agree.
And that's just, it's like, do you? No one else can, right? And if you're not winning by doing you, and you're not winning by doing you, so people try to go do try to be like somebody else. That's what everybody does, right?
Yep.
No, level up. That's not what you do. Just level up.
Right.
Take some of what they're doing to win, acknowledge it, and put your own little spin on it, and go do you. Continue to do you, but just do you better.
Exactly.
You know?
Exactly. Well, Sherman, thank you so much, man, for taking the time out to talk to us. Last thing is, I'm just going to give you the floor to let people know where they can find you if they want to find you and support you in your work, where they can do that.
Absolutely. So website is AINVentures.com. The different team actually developed the website. You can find us there. We are actually going to be developing a contact form where founders can drop decks, upload decks to our site, etc. You can also, if you're a founder, you can email us at deals@academyinvestor.com. Academy Investor. We'll like in this
put
podcast.
It in the description, right?
Yeah, put it exactly. I don't need to spell it. LPs, find me. Sherman@academyinvestor.com. Also founder Sherman@academyinvestor.com. I'll give you guys my email. Probably blow up my inbox, but it's all good. You find me on LinkedIn. Find us on LinkedIn. Find us on Twitter. At Twitter, I'm VC_Sherman. That's my Twitter handle.
Right.
LinkedIn, you just Google my name and find me, or look up AIN Ventures on LinkedIn. Those are the spots, man. We got a podcast coming out. That's actually out. We're already promoting it. We focus on veteran entrepreneurs with a slant towards. We talk about all veteran entrepreneurs. We do have a nice slant towards Black veteran entrepreneurs, which is really cool. Something not widely talked about, and it's been a pleasure to speak with you all, speak to everyone, and let's do it again sometime in the future.
For sure, man.
And for everyone that asks, why not crypto? And we didn't talk about investing in crypto. You answered that when you said it's not the highest returning asset class. That's why it's private equity and VC.
No. It's venture capital, but early stage venture capitalists do invest in crypto. If you would ask me about crypto, I would have went into that, but we can do that in another one.
Yeah, we'll do it on the next one.
I actually love Web3. I'm a big believer in Web 3.0.
All right, well then we got to have another conversation.
I've made several investments in the space myself.
Okay, say less. All right, bet.
Yeah.
All right. Well, yeah, like I said before, we'll leave all of the all the information to reach out to Sherman in the description. So if you're interested, go check that out. Otherwise, thank you guys all for listening. This has been another episode of Navigating Now, a different podcast. Thank you guys so much for listening, and we'll see you next time. Peace.
Thank you.